And welcome. This is Mary Ellen McGonagle with your Friday afternoon MEM Edge show. And this is the show where we bring you where the action is in the broader markets. Let's take a look at what we are going to be reviewing today. Of course, we are going to take a look at the markets and see where did we close the week. Another volatile period as we head into year end. And then also some of those top headline news that drove price action. We're also going to take a look at some of these companies that reported earnings last week, several bellwether names that really pushed the markets around. And then also, will Santa show up next week? We are in that prime period next week for that period known as the Santa Claus rally, where historically that markets do fare well. And then into the first two trading days of the new year. Nothing promised there. But we'll take a look at the markets again, as mentioned, and see where did we close and what we can look forward to potentially. Also, some of these headline news, and there were some pretty heavy-duty data that was released last week. First up, consumer confidence hit an 8-month high, and I believe this was a surprise to many in the face of high inflation, but that did, in fact, take shape. But also, we did see weekly jobless claims inch a little bit higher. So wobbly and mixed as it related to data there. However, we did see U.S. GDP growth for the third quarter was revised actually quite a bit higher to 3.2%, all about that consumer still opening their wallets despite high pricing. I will say most of the spending in that GDP number had to do with travel and leisure. I think people are just still ready to move about after being confined for a couple of years here. Also, we heard last week, or in fact today, a very, very critical inflation number, and that is that core personal consumption expenditures, PCE. This is a very closely watched number by the Federal Reserve because the core number will strip out volatile energy and food pricing so that you can really get a sense of spending habits among consumers. Are consumers trading down in their purchasings and otherwise? So it did show that inflation is cooling slightly. Now, we didn't see a dramatic move in the markets today. Certainly, volume has been light throughout the week. We are in this holiday period, but also that cooling of inflation, not enough to move the needle. So from here next week, actually, we did see durable goods orders drop as the economy slows. So net, we are seeing reduced inflation modestly. We are seeing an economic slowdown in specific areas. However, I think that GDP number midweek did get people a little nervous as it relates to higher growth. That is not good. We're in that period where strong economic numbers will possibly keep the Federal Reserve alert and those interest rates higher. Next up, the economic calendar is very, very light, but we could see, as mentioned, that rally. And then also you will not want to, well, certainly keep alerts if you're not going to be in front of your computer watching these markets, because volatility into year end is also known to be pronounced primarily because of that lighter volume. So from here, let's go ahead and take a look at those broader markets. And here we are with a daily price chart of the S&P 500. A couple of metrics that you do want to be very aware of is the position of the S&P 500 relative to this 50-day simple moving average. When the broader markets, any given indice does have a life below that 50-day simple moving average, not constructive. Ideally, we need to get above this as well as these shorter term moving averages in order to consider getting positive on the near-term outlook. We can take a look at the momentum indicators, the RSI, relative strength indicator, down here in negative territory, and then also the stochastics in negative territory as well. Now, I will note that the stochastics in particular are coming out of an oversold position. So this would be pretty much one of the only metrics that could point to an oversold rally next week. So we will keep an eye out for that. While we're here, I do want to share with you a chart of the NASDAQ Composite, because last week we did see, actually the prior week, a break below that 50-day simple moving average. And the NASDAQ was quite a bit weaker than the other indices, down over 2% relative to the S&P, down about 0.5%. We'll get into the source of that weakness as we move forward. But you can just see that this momentum either trending sideways, not a lot of oomph taking place in the NASDAQ. Let me go ahead back to the S&P, because I do want to share with you where the next area of possible downside support is, and that's going to be the beginning of November, these lows. Should we break below that, we will need to go back to early October and that low point as an area of potential support. From here, let's go ahead and take a look beneath the surface. We want to stay on top of what's shaping up in the various 11 sectors in the S&P 500. So this is a 2-month daily price chart view of those sectors. I've added an RSI and sorted it in descending order. So what we can see, if you watch this show each week, you'll know that we are all about not only uncovering where that relative outperformance is taking shape, but also any possible rotation as these sectors move from these stronger quartiles up here down to weaker, and likewise from those weaker areas up to the forefront. And immediately what comes to light here is utilities, staples, and healthcare up here at the forefront. So we do still have a defensive bias in the markets. Certainly recession fears remain very strong as a backdrop. However, there is a rotation of an sector group that had been languishing down here in this lower weak quartile, and it is progressing to the top performer last week, and it is energy. This is XLE. The group was up almost 3%, and you can see we have these nice higher lows taking shape, the momentum now in positive territory, and then we have this nice MACD black line up through the red crossover, indicating a potential reversal of this downtrend and then basing period. So energy stocks really shaping up as we move forward. We'll take a look at some of the other dynamics within energy, all about demand versus supply issues and rumors that Russia is going to cut their oil output dramatically. So as we move forward, we also need to take care to note what areas are weak and remain weak. First up here would be technology, one of the weakest performers again this week, down 2.5%. We'll get into why, but now we have this MACD in negative territory and the index or the sector now below this key 50-day simple moving average. From here, if we see these shorter term 10 and 21-day moving averages break below the longer term 50-day, we need only go back to historical precedent in earlier periods when technology came under selling pressure. And we'll get into where that weakness is there. And then also taking a look at consumer discretionary. Now, Tesla is a heavyweight in here, and that stock was down 18% last week. But there were other weak areas in this consumer discretionary area. Retail down 2.2%, certainly more than the broader market. So this is another area of weakness. And this is the kind of thing that I discuss in my twice weekly MEM Edge report. And we highlighted over the last 2 weeks the fact that discretionary technology, and there's one other sector that is very susceptible to weakness in the face of recession fears, and it is continuing to play out. So from here, let's go ahead and take a look at some of the underlying sub-industry groupings here in the markets. I use ETFs that I find to be super helpful as it relates to really getting your arms around what's taking place here in the markets. Again, 2-month daily price chart view, and take a look. Gold has been up here in the forefront, and it is remaining up here. We can see that the GLD ETF has positive momentum here, and it has been shown to be a proxy. Certainly, if we go back historically, look at prior recessionary periods, and gold does have that predisposition to outperform. From here, another area that is on the move higher this week, and this is the yield on that 10-year Treasury. We're now back up here to 3.7. This uptick here is not good for growth stocks. I'm going to share with you a chart that will outline it pretty clearly, the response, or certainly what happens when we see interest rates rise relative to growth stocks. Also here, we can move down and take a look at some of these weaker areas. Semiconductor stocks got hit quite hard, down 4% for the week, now down below this 50-day simple moving average with negative momentum indicators. So we'll talk about where that weakness emanated from within software, but by and large, it is not an area to be overweighted, or even I would prefer not to have any exposure because the weakness is real. So up here, if we look at some of these other stronger areas, or certainly areas that are staying up here in the forefront, biotech names, they did get hit. They were down about 1.4%. This is IBB, the more growth-oriented NASDAQ biotech industry group, but we are still finding support above this 50-day simple moving average, and there are pockets of strength that are remaining within that area, which is in healthcare. Let's take a quick look here at volatility, because volatility, VIX, the volatility or fear index, was volatile last week. So we did get that inflation report that came in lower than anticipated, but it was not a big help. We saw volatility drop 5% today. So I'm going to pull up a weekly here to give a little bit of a longer term view here, and you will see that despite a very choppy period for the week, and certainly deterioration in growth areas, volatility dropped 7% for the week, so that we closed here at this 2021 level. And that's actually constructive, but I will note that volatility recently, over the last 2 weeks, has not really been responding in a normalized fashion where you have the markets performing one way and volatility responds very directly. So we are seeing what looks to be volatility or fear reducing or declining, but in fact, that would normally be the backdrop for a market that's on the rise, but it's not the case. So just pointing that out relative to volatility and that fear index. So let's go ahead from here, and I will share with you a couple of other charts that are broader market and really telling. So this is the yield on that 10-year Treasury, and you can see at the beginning of this year. Now, this is really what brought on that bear market as we saw the yields and interest rates rise. That rally that we had over the summer was taking shape during a pullback in the yield on that 10-year. So let's go ahead and move forward, because we did have a recent relatively strong period, October into the beginning of December. But this week, we can see that the yield on that 10-year is up at 3.7%. So we are seeing an uptick. So from here, I will share a chart with you that will provide further intel. And here we are. This is a view, a comparative view. It's a great feature here on StockCharts.com where you can compare the broader markets, different ETFs, and overlay them on top of each other and examine whether there in fact is a relationship. So the bar charts here, the daily bar or candlesticks here are the daily NASDAQ Composite, and it's taking us back to the end of 2021. And from here, this single line is the yield on that 10-year Treasury. So ideally, you can see that as interest rates rise, there's a very, very strong impact on these higher growth names that are in the NASDAQ. So let's go ahead and move forward, and we can share. This is that period when we saw interest rates on the rise, the NASDAQ declining. So currently we are in the period, the beginning stages of the yield on that 10-year rising, and you can see quite clearly that the NASDAQ overall is most negatively impacted. And of course, rising rates are not entirely unanticipated, given that the Federal Reserve repeatedly has discussed the fact that they are going to keep interest rates elevated well into next year with a 5.25 target rate for that Fed funds. So another area or item that we can take a quick look at here is breadth, and that is going to show you that breadth in the markets. This is the percent of stocks in the S&P 500 that are above their 50-day simple moving average. And breadth really waffled quite a bit last week. But what I did want to share with you is if we were to see a continued decline in breadth, in other words, more stocks breaking below that key moving average, that is what in turn had spurred this rally back here, June, and then also this October rally. Now, of course, also spurring that rally, in addition to a deterioration in breadth, was that reduction in interest rates. So giving you an idea of the backdrop. One last area while we are looking at this, I do want to share with you a chart of semiconductor stocks because we mentioned that they are under distribution. This is a daily price chart, and I did want to point out to you the dynamics that take place before a more prolonged decline in these semiconductor stocks. And quite simply, we see a negative RSI taking shape as this SOXX semiconductor ETF breaks below these key moving averages in line with the MACD black line down through the red, indicating that the uptrend has reversed. So in line with that, really your first signal is going to be this MACD crossover. As we move forward, we can see that that took place in the beginning of December, and now we were at a point where we talked about this MACD now in negative territory with your RSI trending downward. So from here, a couple of other areas that I did want to share with you and talk about. I mentioned that earnings were a driver, certainly for the broader markets, and one of the more renowned names that reported last week is Nike. NKE, of course, is the ticker symbol. And take a look, a big gap up, double-digit returns on Wednesday after the company came in ahead of estimates and also guided higher. They're beginning to see more growth in China and elsewhere, and the stock is holding in. In turn, another stock that also reported that day that's well known is Federal Express, FDX. Not quite as strong. They did come in above estimates. Earnings were down, but they came in above estimates. And on this particular day, Wednesday, we did see a nice rally in the markets as really coming in, these bigger companies coming in above estimates raised people's really provided a nice backdrop for the broader markets to trade higher. Other stocks that did report earnings last week and are not as well known, but certainly are heavily weighted. And this is Cintas, CTAS. They are a uniform company, and you can see this nice gap up that also took place on Wednesday. So we did have several companies coming in with nice earnings. Now, of course, not all was rosy on the earnings front. Let's take a look at Micron, and you can see this particular stock had already been trending downward. The company had already pre-announced weak earnings, and you can see this gap down that took place on Thursday as the company came in with earnings that were well below estimates. Management also talked about cutting their staff going into next year due to soft chip demand. So this is primarily where that weakness was really pronounced in and among all semiconductor stocks, which had already been pulling back. So some other areas that I did want to share with you as it relates to what took place in the markets last week, there are some bright spots in areas that are hitting a new high. And as you'll see, a lot of these names are going to be a little more defensive in nature. This is Merck, MRK, continuing to trend higher. The company came out with strong earnings back here in October and has been pushed into a very nice uptrend. From here, we can take a look at a weekly chart of Merck, and you'll see that it is certainly oversold. So at this point in time, I would not be a buyer. This is more for informational purposes relative to where some of these larger companies are coming in with pricing that is putting them at a new high. A number of consumer staples stocks appear as well. This is Cal-Maine Foods, CALM. I'm going to add a 5-day simple moving average. And this particular company is a producer of eggs, and it's an industry that has really been consolidating due to government restrictions, and some of these smaller egg producers are being forced out, so that Cal-Maine, in essence, is becoming a bit of a monopoly. I will tell you, I was at the market yesterday, and for 18 eggs, it was $9. I thought, okay, something's happening here. But Cal-Maine, we can see up here in an uptrend, finding support at this upward trending 5-day simple moving average. Some other areas and names in that consumer staples area that are continuing to hit a new high, good old JM Smucker. And then last up is Campbell's. And these are both, I would suggest, 100-year-old companies, but certainly super well known. The relevance here is that these better liked, more companies, or certainly longer standing, have a lot in the way of loyal customers that are not really pushing back due to increased pricing. CPB reported earnings back here, gapped up into a nice uptrend, and is continuing to trend higher. There is another area when talking about stocks that are hitting a new high. I'm always on the lookout for themes among those names, and there are. First up is the fact that many of these companies came out with strong earnings. This is GFF, Griffin Corp, and you can see it had this nice base breakout and really just consolidating here with nice positive momentum indicators. This is a construction stock. I'm going to show you how you can, what you can do from here is pull up a full quote, and it will provide you with further information relative to a yield, 1%, but then also it's in the industrial space and building materials in particular. And that is, very interestingly, one area that has a number of stocks that are continuing to hit a new high. Actually, this is not in that group, but there are certainly a number of names surprisingly in that group. This is ACGL, Arch Capital Group. Another phenomenon that's taking shape among stocks that are hitting a new high is the fact that they came out with strong earnings and gapped up into an uptrend. This is a very consistent look among those new highs, all about those earnings. This is building support services, MMS, gap up on earnings into an uptrend. So I talked about building and construction stocks. Another theme in these names that are outperforming the market is those companies that provide outsourcing services to larger corporations. So when we're in the throes of a possible recession, you will see more companies using these outsourced services instead of hiring new employees. And then one other area, we talked about gold. I was going to highlight another stock in that space that is looking really quite interesting. This is Alamos Gold. AGI is the ticker symbol, and you can see it's been in this nice confirmed uptrend here. The good news this week was that the company announced a repurchase agreement, and the stock is really setting up quite nicely. I'm going to leave it at that, everyone. I hope you have a fantastic holiday weekend, and I'll look for you next time in the new year.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.